Well, welcome to the Alternative Credit Panel on a balmy day in February here in New York City. We have a very good panel today, a lot to discuss. My name is Jeff Davis. I'm with FirstPoint Equity Capital. We are a 20-person global placement agent. I'm located here in New York City. I focus on origination and distribution. I head our private credit vertical. So apropos that I'm moderating this panel today, our firm distributes product across private equity, private credit, and real assets. And I've been in the placement business for near 20 years, but I've also been a GP and an LP. So I have a good appreciation for different sides of the table. Today we have GPs with you here on the panel. What we'll do is we will give each panelist 2 minutes, let's say, to introduce themselves and their firms. And then I'll go into some high-level general questions that would be shared amongst the four panelists, and then go into some specific questions for each panelist, depending on time. So with that, I'll hand it to Justin to introduce himself and his firm.
All right, thank you. Hey guys, I'm Justin Cooper. I'm managing partner at C6 Capital. We are, we're more like lower end to the lower middle market credit providers. We can invest up and down the capital stack, senior, second, sub, unsecured. If we like a business, we can tell relatively quickly if it's something that we want to make an investment in. And from when we hear a pitch to when we're funding is within a week. So, cash is more important than cost of capital in certain instances, and we're able to charge a lot of alpha for that. We're 5 years old. We deployed, 80 million last year, 25 million in Q4, so we're growing. We don't have any leverage, it's all equity, and we have LPs that invest alongside of us. So for us, we are investing in a section in the market where I think our competitors are kind of like 10 and up, where 1 to 10 will go a little bit lower. So we're able to get in early and often, charge more because we're investing in, call it 3 million of EBITDA below businesses, and then as they mature, we're able to go ahead and write larger checks and siphon them off. So that's who we are, and we're just doing well and looking for more opportunities.
Great.
Jason Block. We're sort of, you go up the scale a little bit into the middle market, credit focus shop. We have about $1 billion of AUM, focus on companies generally averaging about 25 to 30 million of EBITDA, but we'll do as small as 10, and we've done it up to 250 million. Check sizes kind of range the same, average is about 50, but they've been as small as 10 and up to 200 million as well. We actually manage our business in 2 funds, a senior fund and then a junior capital fund. And we have offices in Kansas City, Dallas, and here in New York.
Mike Scarangella from Carlton Credit Partners. Carlton was started by my partner and I, Lynn Wang. She was a partner at Chatham Capital in Atlanta, founder and manager of the private credit group there. I was a decade at Morgan Stanley as a founder and partner in private credit at that shop. We started Carlton to focus on lower middle market cash flow lending to non-sponsor backed companies in particular. We like that niche a lot. We like to work with managers, family members, founders, just to kind of talk about their capital structure and start with a blank sheet of paper and structure something customized for them. Our minimum EBITDA size is about 5 million, and our checks are 10 to 50 million. And we're generally industry agnostic with a couple exceptions, which I think we're going to talk about later.
Right. We have Michael Dasappan on video. Michael, I'll give you the floor.
Yeah. Hi, everyone. Michael Dasappan. So I'm with Liquid Capital. We have an office in the U.S. based in Texas. And in Canada, we're in Toronto. That's where our head offices are. And I'm based in New Jersey. And the company's been around a little over 20 years. And we focus, Liquid Capital, we focus primarily on accounts receivable financing and asset-based lending. The typical deal size for AR lending starts around $250,000. So we work from companies that are in a startup stage all the way to $30 million. We have close to $400 million deployed. Uh, we're part of the Garrington group of companies that was fairly recent, a few years ago. And as part of the Garrington group of companies, we can take on additional financing such as lender financing and specialty financing. So in addition to the AR lending and asset-based lending that we do for liquid capital, our portfolio offerings comprise of a variety of products.
Great,
Thank you.
thanks. So we have a diverse group of lenders here on the panel. Some similarities. I think it would be interesting to just take this high level first, since many in the audience are accustomed to sourcing capital locally from a local bank, for instance. I asked the panel, a high level question, and that is, in what circumstances is private debt an attractive option for a borrower?
I'll take it. So I think especially where we sit at the lower end of the lower middle market, companies that have up to $5 million of EBITDA, most times negative, if they're trading at a revenue multiple for enterprise value and $1 million or $2 million or $5 million is able to go ahead and help them double or triple their revenues at, 4 or 5x their enterprise value, they're okay paying expensive debt in lieu of equity. So I think that's primarily the use case for us. I mean, we're charging 50, 60% APR on our money. So it has to be really, it just has to be worth the squeeze for our clients. And it's really like, can they double or triple their sales in the next 18 months?
I mean, it's funny, particularly with family-owned businesses, which Mike and I spend all our time with here. Debt for years, debt was a four-letter word. Even going to their local bank was a four-letter word. I think what we see is one, as businesses mature, what is their certainty of cash flow? And then more importantly, how much liquidity do they have, right? Like nobody ever goes bankrupt because they have too much debt. They go bankrupt because they run out of cash. And when you have a family-run business and you want to think about the things that are driving for the next generation, making sure that you have the liquidity to move forward. So before you take on debt, whether it's from a local bank or whether it's from a private lender like one of us, we're spending a lot of time on that liquidity and understanding that. And so I think, the banks will often offer you capital that is asset-based sometimes and may compete on that side of the market. But they also will get tapped out. There's a lot of rules. There's only so much debt to EBITDA they can have. They have to have this amount of amortization. And there are all these things that a bank can strangle a company with, not intentionally, just because the capital has to fit what the bank's allowed to do. I think when you work with a private lender like us, we can look at your business plan and the family's business plan and say, hey, we can tailor the capital structure to that plan, which is kind of a reverse way to do it, but a lot better for the company.
Yeah, I would just add to that. So we plug a really important hole in the continuum of financing for lower middle market companies, right? They start out with their local banker who takes good care of them, revolving line of credit, maybe has the mortgage on their, facility. But, someday they run into an opportunity that the bank just won't or can't do, right? As Jason said, the banks are highly regulated, so everything's got to fit to a perfect box. But one day, the management team finds an acquisition that's kind of big, but it's going to really take them to the next level strategically. It's too much leverage for a bank. That's a good opportunity for us. Sometimes they want to pay themselves a dividend. Their whole net worth is tied up in this asset and they don't want to sell it. They're 35, 40 years old, still got many years to go, but would love to get a little chip off the table to fund my kids' college. We can do a levered dividend to the owner. We can also buy partners out. These are transactions that banks don't love because the capital is leaving the entity, leaving the borrower. But this is kind of middle of the fairway for what we all do. And, their only other alternative is equity, and that's super expensive, super dilutive. You have people in your boardroom likely telling you what to do. So we fill that kind of space in between a lender and equity.
And you got to throw the other thing that your laundry list of things that the bank asks for, a personal guarantee.
Oh, yeah.
Right, like that, you're going to hear that from your commercial bank, your local lending agency a lot. You won't hear that from groups like that.
Michael, did you have anything to add?
Yeah, so private debt generally plays in the areas that traditional banks tend to avoid. And so companies that are at a catalyst point in their growth, say they have more opportunity than capital, they're restructuring their business, they're buying, selling the company. So these might be events that traditional lenders shy away and private equity steps in.
Well, I think, this audience understands private credit is not new, obviously been around for a decade plus since the global financial crisis, but certainly before that too. It's certainly more accepted, more common in the private equity landscape. How about we kind of turn that first question around and say, what do the companies say is important to them in terms of choosing a capital provider, given they have a number of options, there's a number of views out there? Start.
How do you think?
Yeah, go ahead.
I mean, look, we have a little matrix that we've given to families to look at when they're evaluating whether they should take money from us or from a competitor of ours or whoever else offering capital. And we talk about things like flexibility, right? It goes back to my earlier statement of building a capital structure for your business plan. Are we going to be able to do what we want to do and execute on our plan? And even if there's volatility in that plan or uncertainty in that plan, do we have the bandwidth to operate in it? You talk about certainty and speed and who you're working with, and do your partners have, does the lending partner you're looking at have industry knowledge? Is it something that they understand, or is there a real risk that they're not going to get there? Timing, time is precious, it's not recyclable. And we ask them about, a certainty of a process. It's not that, we actually don't do anything in 5 days, actually. I'm going to totally disagree. We take a very long time because we're both being interviewed by the people we're giving money to. They're bringing us into their family in many ways, as much as we're getting to know their company and making sure that capital structure is right. And the fourth thing we talked about is price, because, the amount of leverage, the amount of capital we're giving them, as well as the cost of that. And we talk about it not being absolute on what you're paying us, but what is the company getting out of it? Does the family make more money? Is the family's net worth greater from taking on this capital? Is it productive for them? And so we try to steer people to think holistically about their capital provider and evaluate all four of those criteria, which is very different than a buyout sponsor, which is pretty much price and leverage and, don't tell me anything else.
Yeah, I think the question that we get oftentimes from a prospective lender is, how involved in my business are you going to be? And really, the answer they're hoping for is not involved at all. And that's really the reality, 90% of the time, as long as the company operates within the covenants that we set up with them and they meet their plan, we don't get involved. We typically have a board observer seat, which means we're in the boardroom, but we don't have a vote, we don't have a say. We get to listen to what they're thinking about for the business, which is helpful to us as a lender, but we don't influence the strategy in any way. What we do though is we sit on the sidelines with a whole bunch of resources that we have from our careers, right? We have a huge Rolodex of advisors, board members, management team members, and in the past investments that I've made, our borrowers have called us and said, hey, my CFO just quit, do you know anybody? And we'll help plug that hole. Or listen, I really need some new perspectives on my board. Who do you know in my industry that might be willing to join my board? I need an auditor, et cetera. So the way we position is, look, we're not going to bother you unless something really goes off the rails, but we can be a resource to you going forward.
So the most important thing in choosing a capital provider has got to be not focus so much on the cost or the rate, but rather work with somebody who understands your business. So the synergy is very important. The ability for the capital provider to understand the business, the desires of the ownership, the leadership, and a common understanding of what success looks like can many times make or break a relationship. So we feel synergy is more important than focusing on the cost of the rate.
I love his last point there, what success looks like, because I think that's the whole thing is knowing what the family's goal is from this capital and their business, and actually having that on both sides of the table so you can actually measure success rather than what are the guardrails that are gonna trip failure, but measuring success is really key. That's
And
a
then
great point.
for our strategy, we're very fast, right? Like easy for us to identify a hiccup that happens. COVID, for example, we invested in a surgical center in Texas. They weren't doing elective surgeries. They fell way behind with their supplier and they needed to go ahead and pay their payables, which is the tune of like $2 or $3 million. We're like, what is the likelihood that, certain elective surgeries happen again? We're like, very great, fund it quickly. And we were just a Band-Aid, right? Like, so the weighted average cost of capital for us being, subordinate to their senior lender didn't materially change the overall kind of like, interest expense of the business. So they viewed us as a integral part to go ahead and move forward.
Yeah. Michael touched on something about involvement with portfolio companies, with investments, and I think that's an important consideration and dynamic these days in private credit. It's not just about sourcing and structuring and clipping coupon. There are some strategies that take a much more active or proactive approach. Some, we might even say, have a private equity approach to private credit. Activity or active can mean different things. But obviously, as I know, Jason's strategy lends itself well to active involvement. He can touch upon that. But I think also Michael D on the screen in terms of activity and making sure that covenants aren't being breached and just being monitoring of performance and of progress and so forth and footing to the documents and so forth. So I'd love to just kind of open that up in terms of how you define active, if at all.
So post-close, very active. The more collateral-based the facility is, the more collateral has to be tested, the more active the lender is going to be in terms of communication, reporting with the borrower.
Right. And Jason, maybe give an anecdote or two of.
Yeah, I think Michael hit some of those points pretty well, and it's the years of experience, right? So it's a lot of our LPs and our funds are family, or people who own their own family businesses, ran businesses, et cetera. A lot of our partners in the business when we built our team also ran businesses. So that Rolodex, those ideas of working with a company that we kept looking at their balance sheet, and they have a full-on daily revolver, but there would be a couple $1 million of cash on the balance sheet every day. And we said, you realize that you got $5 million of cash on your balance sheet every day, you're paying 4% interest on that. That's real money over the course of a year. We can give you the tools to help your CFO understand how she can have that be zero every day. And if she has to hire somebody, the cost of hiring that person who can then do other jobs is way less than the interest you're going to save. So there's little things that being, kind of professional investors for years, whether it's through our Rolodex, our network, our industry contacts, or just some best practices that we've seen. We don't run the companies, right? We sit in the boardroom, we're often observers, sometimes voting members of your board, depending on what you want. But we will engage and we will try to influence you with things that we've seen in those best practices. And you have to choose if you want to use them or not, but we can put them in front of you.
Yeah, and I think, we're gonna move to another topic, but we're getting a little bit to the alpha generation that some credit managers can affect, and then, there's beta generation, there's, both are well received and both have a place, but the private credit universe is, in terms of strategies, is evolving on a daily basis, and it's quite interesting. When we talk about, just this, the ability of these businesses to access capital post-pandemic, is there, what do you think will be the trend? I guess we are post-pandemic, we're getting there.
We have Maximum Thunderdome world, so we are
Exactly.
close to the top of the
Exactly.
world.
I think it's still going to be challenging for businesses that have, sub $5 million of EBITDA to go ahead and get additional leverage outside of a factor or a traditional bank loan. And if they want to go ahead and grow, like what's their alternative to going ahead and you go ahead and sell some equity? Maybe you don't want to, but I think they're going to have to use private credit guys to go ahead and expand their businesses, do tuck-in acquisitions, things like that. So I think private credit is,
Can you talk about the way, I mean, when you're structuring deals for sub 5 million, are you guys taking warrants in those companies, or how does that work?
So look, historically, we haven't really taken equity upside. We try and go ahead and get exit fees, things to go ahead and juice our fixed income return. If it was a situation where, we needed warrants to go ahead and offset some risk, we'll go ahead and, take it. But historically, we're like, look, we're a non-dilutive capital provider. You're gonna pay us a fixed income rate. We're gonna go away within a year, and then you can go ahead and, maintain, the full piece of the pie.
And the rest of you?
We take equity in almost everything we do. It's usually a discussion with the family of what form that should take. It's not necessarily being in their LLC. It's sometimes we do it by contract. But the idea is to create some alignment. It's usually not enough that it matters to the family, and it's usually enough that when we sit and engage in these discussions and there are strategic things in the company where they can change their equity trajectory again, right? They may have actually changed it with taking our capital once, and there's another chance to step up or do something strategic. If we're coupon only, there's a potential that we just say no because you're changing our risk. If we're participating and being their partner, we can have a real discussion of what risk they're taking, why we're all comfortable with it, and we participate a little bit in that upside. But we do like to create that alignment.
We take a slightly different view. We're going to try to make everything work within the context of the coupon and the fees. Our initial proposal is usually not going to include equity upside. We find that entrepreneurs are really, really sensitive when you kind of dip into their equity. It starts to look and feel a lot different to them, right? Their frame of reference is the last bank loan that they took. And even though ours is better, it doesn't have guarantees, et cetera, suddenly if you say, hey, I want 10% of your company in warrants, it tends to change dialogue. So if we can, we have a coupon, we have some closing fees, we have some prepayment fees, and all those wrapped together usually can get us where we need to be in terms of IRRs.
Are your fees less than the 7% that Randy was talking about on the private equity side, or?
Our fees, yeah, they're definitely less than 7%. Although if that's an opportunity, we should talk about it.
Mike, did you have something to add?
We're collateral based, so we're not looking for equity. So typically, we're looking to exit at some point. We consider ourselves short-term providers. And,
Okay. And
in
before I
many
get to-
cases, other than a pure AR lending, which doesn't come with a term built in, all of our other products are term-based.
So if you take a look at like past lending experience from private credit groups, like back in 2008, all these hard money lenders came to New York and other places, and they lent money like crazy before 2008. And then they got locked up in these terrible loans to real estate that got stuck in courts for years, and they weren't able to guarantee liquidity anymore to their customers. Like the kind of lending that you're doing right now, can you talk about, the regulatory environment for what you do in case anything changes because of, interest rate hikes, and also you talk about like the impact of the interest rate hikes,
Inflation.
If the Fed goes through with that stuff, can you talk about that?
Yeah, I mean, look, in terms of raw material costs created by supply chain disruptions, rising inflation, I mean, all of that's got to factor into the model that we create for the forecasting the company. So we'll want to stress test, the impact on their gross margins to see if they could sustain, increases. Our debt is floating rate, so if rates go up, that's, generally good for us. Again, we have to make sure the company can pay that and their coverage ratios look acceptable. But look, it's all about trying to anticipate, what's coming down the pike, trying to model different scenarios, and trying to make sure the company's cash flows can cover it.
I think what's happened going through the pandemic has been a phenomenal way to help us work with management teams, because as you went from 2013, really, as you went from 2002 to 2019, let's be clear, it was a financial crisis in 09, 10, it was not an economic crisis. I'd say some management teams got lazy. They could get cash whenever they wanted, they could get cash later, they didn't think about liquidity, they didn't think about shocks to their business. I think we love being now having both operators on our team, as well as our partners, as well as the management we talk to, being able to have these discussions of how are you going to pass through costs? Is your product differentiated and defensible in a way that you have something that's needed, something that is going to be there through cycles? Assume there's going to be some other bumps in the road when you take capital. Those conversations are phenomenal. And I think when you invest in either our products, we happen to be fixed rate because we think a lot about that company's liquidity more than our returns. And our average coupon's 11%. So if we're talking about a time where treasuries gets to 7, 8, 9, 10%, and that spread is massive, we have all different problems in this country to talk about. But if we're talking about 200 or 300 basis points in treasury, we're still wider than anything else out there. So I'm less worried about our IRR return because we'll compound for longer, our money multiples will be better. But we think about all of those factors going into every time we put a security in place. And the crisis has been a great equalizer to have real conversations about real issues that in 2019, we had this approach and it fell on a lot of deaf ears. And so we actually didn't do a lot leading to the crisis. And the portfolio we had in the crisis did great because those were managers who were already thinking about not a pandemic, but owning the company and having our capital structure in what might be volatility.
We see like a bunch of opportunities now with private equity firms shedding some of their, losses because of COVID. Burger King franchisees that food costs went up, or hair salons or stylists that had to shut down in COVID, and these have negative EBITDA. So we're helping sponsors go ahead and purchase these businesses, and we need to charge equity-like returns, but we're doing it in a fixed income vehicle. So after we're gone, they're owning all the equity and moving on. So there's a lot of opportunities. If you can be like, if the last 2 years didn't happen, how would a business perform? And helping entrepreneurs go ahead and pick that up. So that's one of our key focuses this year.
Do you have any thoughts on venture lending?
So how do you deal with, and I'm coming from the other side of the coin, it's not going to look like 2019 again. You can't just say that the model is going to look like it did before the crisis. How are you helping them think about what does it look like going forward? Because it's not just because we're not wearing masks in this room, it's not 2019.
Well, I think some businesses are kind of like immune to that, right? If we're looking at a super cut franchise here, like people need to go ahead and cut hair. The problem that we have right now looking at is like very hard to go ahead and find stylists. So you have to go ahead and look at it, okay, with the macro landscape, people want to get paid more, people don't want to work as hard. So you have to go ahead and tailor a product that makes sense there. But I think overall, if there was a business that was doing $10 million pre-COVID, you could arguably make $3, $4, $5 million of EBITDA, and if we could help them get the deal done and move on and move to a lender like you after they can show some EBITDA after a couple of quarters, we've done our job. So we're not like long-term alternative debt, right?
Mike P, D, right? Why don't we put a question to you specifically about your business? Can you explain the investment criteria that Liquid uses across asset-based lending? And or lender finance, factoring, specialty finance, because I know you do all that. What are the synergies for borrowers as well, if any?
Sure. Thanks, Jeff. So the key components are going to be centered around what we call the 3 C's. It's going to be character, collateral, credit. So character is like dealing with people, a good character, good background, history of solvency, generally paying their obligations as they come due. So that's going to be key. The collateral would be the underlying assets against which we would be providing margins or advances. The ability to discern the value of the collateral. So if it's AR, the goods or services that are provided on a full final basis to a credit-worthy end debtor who's willing and able to pay in terms. If it's inventory, it's finished goods that can be valued on a net orderly liquidation value basis. it can be evidence to convert to sales AR in a reasonable period of time. If it's machinery, equipment, it's got to be used in the normal course of business. That can also be valued on a NOLV basis. So those would be the criteria that we're generally considering for a variety of products. Obviously, this doesn't cover lender finance, but typically on a ABL facility or a factoring facility, those are the things that we're looking for.
Okay, very interesting. Mike asks a question regarding Carlton. What does a Carlton loan look like? And also what industries?
We're getting some reverb.
What industries are attractive and which will you avoid?
Sure. So typical deal for us, again, check sizes 10 to 50 million. We're going to do probably a 5-year maturity, usually prepayable within 18 to 24 months at a premium, kind of like a bond, 103, 102, 101. We're going to have a couple points fees at closing. We're going to have a cash coupon that's floating rate that's going to be anywhere from high single digits to low double digits. In terms of covenants, we'll probably have 3, usually a fixed charge and interest coverage and a leverage covenant. We'll require monthly and quarterly reporting, and as I mentioned earlier, we'll ask for a board observation seat so we can sit in the room and understand kind of where the company's going strategically. In terms of industries, we're fairly agnostic. I've spent most of my career in healthcare and business services, so that's a focus of ours. My partner's done a lot of consumer-facing businesses, industrials, and tech. We like distributors. Couple that we won't do anything commodity-oriented. We won't do anything highly cyclical, like kind of contractors or construction. And we don't do distressed or startups. But other than that, we have a pretty broad appetite for most of the industries that lower middle market's involved in.
And is there an industry you're most excited about coming out of COVID? Venture guess to healthcare maybe?
Yeah, I mean, there's a lot of great stuff going on in healthcare. We have a lot of people bring us crypto-related deals. We're still trying to figure that out. I think someone's going to tell me the answer later on in the conference.
Okay.
But
That's the next round.
yeah, it's the next round. Good, I'm sticking around for that. But listen, the fact is, every financial model we look at, every set of financials shows a big bump, right, in EBITDA, and actually, so it's not whether these companies are doing well post-COVID, it's how much of that is sustainable, because some of it is pent-up demand. And so the challenge that we have, I'm sure you guys do it as well, is to try to strip out, what's pent-up demand and what's real run rate demand. So that, listen, that's what we get paid for, but that's the challenge today.
Can I go in a slightly different direction of something Marty said before? And we heard it earlier about, finding alpha in what you do. And I think I look and I listen to all of us talk here. Private credit it's been around for 30 years. I mean, it was 4-2 private, sold to insurance companies for years. It morphed and we had BDCs and it's had lots of different brand names. But the private credit beta, you can get all over the place. And it's actually pretty good. Private credit as an asset class is going to do better than the high yield market. You can buy the high yield index, its volatility is crazy. It's going to do better than your munis and treasuries even after tax, and credit by itself is not the most tax efficient, but it all is still better. What I think you have here, which is sort of an interesting group, you have real alpha at the table. And it's not, our portfolios can't be bought by buying a public BDC, can't be bought on, Goldman or Morgan Stanley's run, because they're buying sponsor-backed, cookie-cutter things and they're all good investments. The beta is really good in them, but it's the same buyout sponsors to the same lenders to, traded across a portfolio. And I think I listen to this panel and I listen to what everybody's doing here. This is different. And it's the type of family businesses that a lot of the families at these conferences have owned themselves, et cetera, at one point, or maybe still own, that we're touching in different ways.
Yeah, no doubt. And that's what I was getting a little bit at before. I didn't spend too much time alpha generation versus beta generation, but private credit has really progressed in terms of the active role that managers can take in shaping companies and their loans, or Maybe just a question on that note, just getting into the detail, because I think what you do, Justin, is maybe less understood or frequent in the special sits liquid or microcap area. You have various metrics that you use in your investing program, ranging from prepay rights or prepay rights and remittance and others. Maybe talk a little bit about how detailed you are in that sense.
So over the past 5 years, we've pretty much figured out a formula that makes sense. It's a box. It's 10% of revenues to 1 turn of EBITDA is what we're going to go ahead and invest. And what is our loan to enterprise value? We're trying to get 15 to 1 minimum, really 25 to 1. So we have the ability to go ahead and then do senior, second, sub, unsecured. We can invest in publicly traded companies where it's an off-balance sheet items and don't have to file an 8K. So we've thought of a lot of creative ways to put capital on balance sheets, but ultimately it's this box, right? So long as 10% of revenues and it's an enterprise value of 15, 25 to 1, we're going to go ahead and stroke a check, and it's going to be much higher alpha than everyone else on this panel is charging, right? Like we're charging 3% a month for our capital, right? So we're short term, we get lots of deals done. And how do we do that? We have a team of 20 kids out of college, or we're doing about 1,000 intro calls a week with, other lenders, bankers, consultants, and reach out to companies directly ourselves. So we're doing 2 or 3% of the deals that we have origination calls with, but a few of them hit the box, and that's what moves the needle for us and our investors.
Right. Okay. Yeah, and I think also to Jason's point and to what you're hearing here about the active involvement and the level of diligence, the level of work and participation with these companies, it also helps justify some of the fees that credit managers charge. And obviously there are fee streams or fee constructs that are lower, but be interesting to hear what you guys have to say about how you support your fees with investors, if you had issue with that or not.
I mean, we're of a scale where, nobody's getting rich on management fees. This is not even at $1 billion of capital with the team of 10 senior professionals we have and about to have 20 total, it barely covers the nut every year in terms of that. So I don't think we ever have an issue of, hey, are you aligned? And the way we make money is when our investors make money. So, European waterfall, carry the back end, et cetera. So I don't think that's ever been an issue. And I think the net returns and what we're all doing here, and we're not looking at 1,000 calls a week, we're looking at 5. It's a little bit, just in terms of a difference, but, I don't think there's really not a fee issue in this. I don't think we're over or undercharging. I think it's pretty fair across the board here.
How do others feel? You feel you're undercharging?
So was that directed to me?
Well, yes, you or anyone here,
Okay.
We have about 5 minutes.
Okay.
If you're yielding 2.5% to your investors a month and they're not happy with your fees, then investors are never going to be happy with fees, right? So as long as you can make them a decent fixed income return, I think that ultimately that's what they're happy
Yeah,
with.
I think it's relative to alternatives and fixed income, right? So investment grades 2.5%, high yields 4.5%, right? So all of us on this panel, net of fees much larger than what we charge, would generate higher returns than that. So I think if you want to be in fixed income, I think this is a great bucket.
Do you have anything to add, Mike?
So as a direct lender, our fees are anywhere from the high single digits to the mid-teens. Our most expensive product would be the AR financing, which would range anywhere for 1.5% a month to almost close to 2.5% a month. But for that, we're doing full collection activity for the client.
My last question is, so are all of you guys like senior in the stack or in the mezz, or you talk about like where you are in the structure? And then so again, I'm going back to the hard money days when everybody got locked out. And just from a regulatory point of view, I mean, how do you guys manage the risk if, somebody defaults? I mean, it sounds like you guys review your underwriting and see if somebody has the capacity to pay higher interest rates. So can you just talk around that, like where you are in the capital stack, senior, mezz, et cetera, and then go from there?
Yeah, sure, man. In a perfect world, we'd love to be senior. A lot of times we're not. So we do ask for personal guarantees if we're going to be unsecured. But when we are senior, kind of probably like Michael, we want to lockbox AR, we want to put DACAs on bank accounts. We always look for, like, in a reasonably bad case scenario, how do we get our money back? And that ultimately is like some sort of credit hook that we can go ahead and take. So I'm pretty sure we all have a similar view on how do we not lose. As far as regulation goes, I would think it's probably most risky for me because we are charging higher than, we are charging usury rates, although sometimes they're not in loan products, they're in, receivable-based products. And there are certain states that have better laws and regulation that we take advantage of to go ahead and offer our products. Yeah, that's my 2 cents on it.
We're senior in the cap stack. We're generally going to be senior secured, and so our expectation is that we're going to get out whole. We're at least going to get our money back, even if there's a problem. But I think all of us are going to do a rigorous underwriting process to make sure, even if the cash flows are impaired, we have a second way or a third way out through a sale or an asset sale, or bring in a restructuring group to kind of revamp the company strategy and work their way out of it. I mean, I think we're all going to be pretty patient capital when we do hit a speed bump, because nobody really wants to own a business that they've lent money to. It's not how any of us are set up. But it's, fortunately for us, it's pretty unlikely in that scenario.
Yeah, Mario, we tend to be junior capital, depending on, we always want to fit the business plan, but we tend to be junior capital. And so that does put a little bit of a different risk and twist on what we're doing. We both have partners who are operators of businesses on our team, as well as limited partners and resources to help companies self-correct. We don't want to take over a company. We don't want to have to step in and enforce our creditors' rights. And the fact is, back to Michael's point on patient capital, about a problem a year before it happens, right? We all have these covenants. They're all great, but they're they're rear view mirror looking, right? So by the time you trip a covenant, we're a specific example. Company made an acquisition. There was actually fraud in what they bought. Forgetting about that, management team came, presented what they learned, what had to be done to fix it, the whole thing. Walked out of the meeting with the owner, and the owner said, "What do you think?" I was like, "Well, management team was on top of it. They were honest about it. They didn't point fingers on who did what. They took it as they now owned it. All the things you want to see." And I said, and this was in August, and I said, "We're definitely going to break next June's bank covenants, and we're probably going to break March, but definitely by June. We got to go and put together a model and go talk to the banks now and make sure that," and by the way, I said, "You probably have to write a small check to right size this capital structure, because here's what the bank's going to want." And so we started the process a year before they ever violated a covenant on fixing the capital structure, showing that the management team had their arms around it, and solving the problem. So I think you can work on those things. It's not every time it's perfect. We have had companies that have gone through bankruptcy before, and we've had to take back equity for some of our paper, and we've had to change management teams and do those things. They all happen, and I think you got to be prepared for it and have the right team.
Can each one of you take a minute out of your time and just kind of like wrap up and talk about parting thoughts people should be thinking about the existing credit market, where things are going, in particular how investors should be looking at you, people who help you fund your deals, et cetera?
Yeah, I can start. Listen, I think, as I mentioned earlier, I think this post-COVID period is going to be a great time to put out debt capital. I think a lot of companies have deferred CapEx, have deferred acquisitions, have deferred other projects, and what we're hearing is they're back, they're ready to go, and they need capital to do it. So I think it's going to be good opportunities. Personally, I think from an investment standpoint, I think we provide a really attractive spot to invest between lower yielding, close to risk-free fixed income assets, high yield, 4.5%, and there's us kind of in the low to mid double digits, and then there's equity, right? I mean, people are looking at the equity market saying, gee, it looks a little toppy, geopolitical events, Fed, I'm worried, well, where am I gonna go? You know, I would offer right here is a pretty good place to go next and to explore, and, you know, we'd love to help educate people that want to hear more about it.
I think it's, especially when you start writing checks 10 and above, it's a pretty crowded space right there. Everybody's doing private credit. So it's how do you go ahead and get deals, you know, done? How do you see the deals? How do you get them done? How are you making sure there's a bank's not running a process to do it? And I think that, you know, there's been a fundamental shift where I'm certainly paying advisors buy-side fees to come in to bring us deals, right? So I think that, you know, there's a lot of money out there, there's lots of good deals coming out, and, you know, it should be a pretty good run in the next, you know, 5 years.
Yeah, I mean, I would take a slight difference on the crowded market, because when you get to the larger companies, if they're sponsor backed, there's a lot of companies out there doing it. You've all heard all the names, you've all seen it. If they're family-owned businesses, there's nobody. And why? Because they don't show up with a book that says, here's our business, here it is packaged nice and pretty, and can you give me a term sheet and fill in the 2 blanks? And that's what the people who are in the sponsor-backed business are doing. I think from Michael and our side on this point, Michael's a little bit smaller companies than we are. Most families aren't banked. They aren't called on by people they can work with. So this has been probably coming out of the pandemic, the best our pipeline's ever been. And most of it's because, Michael said as well, people are trying to figure out where their business is going for the next generation, not just the next decade, not just the next 3 years, but actually the next generation of their family. And as they think about those things, and there's 30,000 private companies, there's like more generational transition than there's ever been before. As they think about those things, they're looking for somebody who's going to be like-minded, be patient capital, sit with them. We expect to be in a company for 3 to 5 years, and not because we want to. If they grow faster and can refinance us, that's great. But we're going to go in with the assumption that we're going to sit there for a while and be their partner and help them get to the next level, whatever they're trying to do in their business.
Michael, final words?
Yeah, I'll make it quick. So we're a collateral-based lender, so we offer a variety of products all the way from receivable financing to very sophisticated financial instruments. We're pride ourselves on being able to collateral, take whatever that they have, the assets that they have on the balance sheet, and be able to use that to grow the company. The products that we offer fit a variety of companies, but we're not always the best solution. We have a really good team of underwriters, and we try to make sure that we're in the right relationship right off the start, as opposed to taking on somebody who might not be a best fit for us. We're typically looking for short-term engagements, and so I'll end with that. Thank you.
Okay, thank you.